Imagine working your entire life, earning decent money, doing everything right, and still ending up with less wealth than someone who started later but understood the rules of money. Sounds frustrating? Welcome to the reality of money, taxes, and investing. And today, Money Monkey is not just here to entertain you. He's here to make sure you don't make the same mistakes most people make for 40 years straight. Because even in the jungle, there's one rule. If you don't protect your bananas, someone else will eat them. What's up, everyone? Welcome back to Money Monkey. If you're new here, this channel is all about making money simple. No complicated finance talk. No suits, no nonsense. Just clear strategies, long-term thinking, and a monkey who takes investing very seriously. Today, we're going deeper than usual. Because this is not just about taxes. This is about understanding how wealth is actually built. And if you don't understand this, you could be losing thousands every year, quietly, slowly, without noticing. Let me ask you something. Right now, what are you doing with your money? Are you saving it? Spending it? Letting it sit in your bank account? Because here's the truth most people don't like to hear. Saving money alone will not make you wealthy. It might make you feel safe, but it won't make you financially free. Money Monkey learned that the hard way. He once saved a pile of bananas for months, and then they all went bad. Very emotional moment, but also very educational. Here's the mistake most beginners make. They focus only on earning more money, higher salary, more hours, maybe even a second job. But they never learn how to keep that money, and more importantly, how to make it grow. And that is the difference between working your whole life and actually building wealth. Money Monkey always says, it's not about how many bananas you collect. It's about how many banana trees you own. So let's simplify everything. When it comes to money, there are only two paths. Path 1, you work for money. Path 2, money works for you. Most people stay on path 1 forever. They wake up, go to work, earn money, pay taxes, spend the rest, and repeat this cycle for decades. That's not financial freedom. That's a routine. Now, path 2 is different. This is where investing comes in. Instead of spending everything, you take a portion of your money and you invest it into assets. Assets are things that generate income or grow in value over time. Examples: ETFs, stocks, real estate. And here's where things start to change. Because once your money is invested, it starts working, even when you're not. Even when you're sleeping, even when you're watching TV. Money Monkey calls this passive banana production. Now let's talk about one of the most powerful tools for beginners, ETFs. An ETF, or exchange-traded fund, is basically a collection of many companies. Instead of betting on one company, you invest in hundreds or even thousands at once. For example, a global ETF includes companies from all over the world. Big companies, small companies, different industries. So instead of trying to pick the winner, you invest in the entire system. And historically, that system has grown. Over long periods, the global stock market has returned around 7 to 10% per year on average. Not every year. Some years are negative, some years are strong, but long term, it grows. And that's what matters. Now, here's the problem. Most people don't think long-term. They think short-term. They invest. The market drops. They panic, and they sell. And just like that, they turn a temporary loss into a real loss. Money Monkey sees this all the time. It's like planting a banana tree and digging it up after 2 weeks because it didn't grow yet. That's not how this works. Wealth takes time. Now let's talk about the most important concept in investing: compounding. This is where things get interesting. Compounding means your money earns returns, and then those returns earn more returns. And over time, this creates exponential growth. Let's break it down. If you invest 300 euros every month, that's 3,600 euros per year, at an average return of 8%. After 10 years, you might have around 50,000 euros. After 20 years, over 160,000 euros. After 30 years, over 400,000 euros. But here's the crazy part. Most of that growth happens in the later years, because your money has more time to compound. That's why starting early is so powerful. Or as Money Monkey says, the first bananas are slow, but later the jungle grows itself. Now let's talk about something that silently destroys wealth: inflation. Inflation means prices go up over time. If inflation is around 2 to 3% per year, your money loses value. So if your money is just sitting in your bank account, you are actually losing purchasing power, slowly but constantly. That's why investing is not optional. It's necessary. Money Monkey hates inflation because it's like termites eating your banana storage. You don't see it immediately, but over time, everything is gone. Now let's bring taxes into this. You don't need complicated strategies. You don't need risky tricks. You just need to understand one simple idea: timing matters. In many cases, you are taxed when you sell an investment, not while it's growing. That means if you invest long-term and avoid unnecessary selling, your money has more time to compound, and that alone can make a huge difference. Also, long-term investing is often treated more favorably than short-term trading, which again rewards patience. This is why constant buying and selling usually hurts beginners. More stress, more fees, more mistakes. Money Monkey tried trading once. He pressed the wrong button and accidentally sold everything. He still thinks about that day. Now let's make this practical. What can you actually do starting today? Step 1. Open a brokerage account. Step 2. Choose a simple ETF. Something broad, diversified, and low cost. Step 3. Invest regularly. Every month, no matter what the market is doing. Step 4. Ignore the noise. News headlines, market predictions, hype stocks. None of that should control your decisions. Step 5. Stay consistent. Because consistency beats timing. Every single time. Now let's talk about fear. Because everyone has it. What if the market crashes? Here's the honest answer. It will. At some point, the market will drop. But historically, it has always recovered. And often it comes back stronger. So instead of fearing crashes, you should understand them. Because during a crash, prices are lower, which means your money buys more assets. Money Monkey loves discounts, especially banana discounts. Now think about your future: retirement, financial independence, freedom. This doesn't come from one big decision. It comes from thousands of small ones. Investing regularly, staying disciplined, avoiding emotional decisions. That's how wealth is built. Not fast, not flashy, but real. So here's the most important takeaway from this entire video. It's not about how much you earn. It's about how much you keep and how effectively you invest it. Start small, stay consistent, think long-term, and give your money time to grow. Because time is your biggest advantage. And the earlier you start, the more powerful it becomes. Money Monkey understands this. That's why he's sitting in the jungle with a laptop, a portfolio, and a very relaxed lifestyle. instead of worrying about money. If you enjoyed this video, hit the like button and don't forget to subscribe. Because here, you learn how to make your money work for you, not against you. And remember, if a monkey can build wealth, you can too. This is Money Monkey, and I'll see you in the next video. Monkey Money Bag.